Hey, thank you for coming to this workshop. Today I'm going to talk about how to retire early, and I'll be sharing with everyone a stress-free strategy to get out of the corporate rat race. And before I begin, the usual disclaimer, all right, where I make references to investment securities, they are not a buy or sell recommendation, and myself or Dr. Well will not be liable for any losses or damage caused by the information contained in these notes. All right. So with the disclaimer out of the way, my name is Christopher Ng Chung. Some of you might have come across my YouTube channel called Growing Your Tree of Prosperity. I wear many hats. I'm an adjunct law lecturer with Temasek Polytechnic. I have degrees in engineering, applied finance, and law. The first phase of my career, I spent 14 years in the IT sector. And during that time, I authored 3 books on personal finance. One of my books, Growing Your Tree of Prosperity, was a bestseller in 2005. And I've since appeared twice in the Me and My Money column on the Sunday Times. And there is an episode on me on Money Mind last year. I've gained financial independence at the age of 39, which is why some of you might be listening to me today. All right, so with that out of the way, all right, what is the economic backdrop that we are in? The amount that's given by Singapore savings bonds. Sorry, yeah. Let's move on. For our agenda this evening, we will be talking about our lives and breaking it down into 4 parts: spring, summer, autumn, and winter. Each season that we go through in life will present special, right? This presentation would take about slightly more than an hour. We will then have a 5-minute break, and then I'll spend 20 to 30 minutes talking about the early retirement master class. All right, with the Q&A happening between 9 to 9:15 that timeline. All right, so I will only get into the chat box then. So please be patient as I go through my material for this evening. All right, so let's begin and let's talk about our lives. Our life can be broken down into 4 seasons: spring, summer, autumn, and winter. And we're going to jump straight into spring. And spring is where most of us spend most of our time schooling and starting our career, but it's also the time where our relationship with money might be established, right, fairly early in our lives. For me, in my early influences, my dad is the founder of one of the most extensive pet shop enterprises you will find in Singapore today. So I grew up in a retail environment where I experienced what it's like to be a tenant, right? So um, my dad and mom ran a pet shop, and we had to make rent a month. And sometimes when we do not generate enough sales to pay the rent at the end of the month, my parents would often fight, right? And so growing up in this kind of environment, I became very wary about the power of a landlord have over the power of a tenant, right? So throughout the rest of my life, when structuring my finances and my father's finances, you'll find this theme repeat itself over and over again as you listen to me through this evening. I've also learned quite early in my career that you can't really trust financial advisors. Many years ago, when I was about to enter national service, my mom got for me some sort of insurance plan. And what it's supposed to do is that it would require a premium payment every year until I started work. But when I started work, the letters for the premiums kept arriving, and the company pretended that nothing has happened, right? So I brought all the documents, lodged a complaint with the company to find out what is wrong with the particular program. And we were told that there were only two options available for us. Either we let the insurance policy lapse or we continue paying for an unknown period of time. That left a very bad taste in my mouth, but the good thing is that quite early in my career, I realized that you can't really trust the sales pitches made by these insurance agents. And so because of that, I would unfriend or I would ignore any attempts, to meet me, for a drink, somewhere. All right. And as a consequence of that, you will find out that I'm able to build a financial portfolio that's very different from the people in my age category. One of the problems at Spring is that personal finance is not taught well in school, right? Money is not a subject that is examinable. In fact, in our education system, we are taught to be an obedient employee, and the consequences of compound interest generally not shown to secondary school students. But most importantly, no one actually teaches people how crippling it is to pay all these expenses in an investment product, right? As a consequence of that, we have an entire middle class in Singapore that is always broke, right? Either trying to pay for a mortgage or trying to look for money to pay for their expensive insurance premiums. And even though they might be comfortable enough to go on a holiday every year, the truth is that our life exists in the form of a golden handcuff, right? And it's not easy to break out of that, right? So one of the questions that you might have is how do we pick up these crucial personal finance skills if you're not taught well in school? Right. So one way is to look at popular finance books as a way of solving that problem. So for my generation of readers, we were brought up on the Rich Dad and Poor Dad books by Robert Kiyosaki many years ago. And if you read one of his books, it's very motivating. But you really want to find out more about investing, so you go on to read his second book and his third book. And they all sound the same. After a while, it's actually very repetitive. It's only after the fourth or the fifth book where I realized that actually Robert Kiyosaki is a creature of MLM, multi-level marketing. In one of his books, The Business of the 21st Century, he attempts to brainwash or subliminally program the readers to be more open towards these MLM business plans, right? And for the folks in my generation, especially when unemployment is up, a lot of these MLM companies would then emerge and offer business distributorships to a lot of helpless individuals, right? And led to a lot of like friends, losing their friendships, alienating people in the family, right? So that's happened to people in my generation. If you were to think that, 20 years ago for folks of Generation X, and you want to try to attend an investment course, then the situation may not be that good as well. And to make sure that I do not defame people who might still be active in the circuit, instead, I would like to present a Singapore High Court case called Freely Private Limited and Ong Kai Lee. Okay. And everything is published, public domain. All right. And this case allowed us to look into what some of these options trading programs teach. All right. So we have a 3-day course. And throughout these 3 days, all the instructor did was played music and screened movies unrelated to options trading, like American Idol snippets, told students to go to the Rolex, diamond, and fashion handbag stores to imagine becoming millionaires. The trainer even got angry when students told him to start teaching options trading. And what was the outcome, right, for this particular court case? In this case, the High Court ruled in favor of the students. The course fee was reduced by $885. Course fee for software and the webinar was fully refunded, right, with an additional compensation of $10 for each student, right? So we've learned that 15 years ago, our courts will determine the fair price of an investment course. And so as a consequence of that, you notice that investment courses these days are a lot cleaner, right? Because basically judges have taken action, right, by coming up with case law like this, right? And the news gets even worse. If you study finance formally as a subject, as a diploma program or degree program, you'll find that some of these models are not easy to operate as well. What I have here is the discounted cash flow formula that is used for people to value a particular asset. Can be a stock, can be a business, right? And what finance students are taught to do is that they have to do two impossible things to get a valuation. The first is you need to project these cash flows into the future, right? So we have them here, right? Right? And then after that, you need to apply an interest rate to net present value it to the present day, right? To create a valuation. You need to discount it by a certain interest rate, all right? So this interest rate is also subjective, right? It can be the inflation rate, the bond rate, it can be anything you want, right? So without an agreement of what the future cash flow is at the discount rate, for every different analyst who wants to look at the price of an asset, they will all come up with a different answer, which is why when different brokerage houses come up with a target price for a stock, you will end up with answers that are all over the place. All right. So that's part and parcel of operating in the world of finance, right? It's not physics. Okay, it's definitely not maths. If you want to learn and invest the right way, there are better books to follow. And you can use the control print screen button on your terminal to take a screenshot of these two books. The first book is The Richest Man in Babylon. This book is almost 100 years old. It's got very down-to-earth advice on money management, which I think is really the missing piece in a secondary school education. So much so that I use this book to teach RI students about personal finance when I get invited for their gap semester every year, right? The second book is very dry, but it condenses the foundations of investing into a tiny volume. This is called The Conceptual Foundations of Investing by the Cornells. And this is a very good, very short book for people to get a very firm kind of foundation on investing. All right, so these are very good books for you to get started with. All right. And Spring is about the importance of personal finance as a life skill. All right, so we're done with the season of spring. So let's move on to our next season. And the season of summer is the second quarter of your life. And this is a very exciting quarter because you spend most of this time making your money and you start a family at this stage. All right, a lot of things happen in summer. And for me in summer, I worked in the field of IT outsourcing. Just after the dot-com bust in around 2002, Singapore also began the massive import of foreign talent. Many IT professionals from India and China came to Singapore to compete with local engineers, right? And there was an outsourcing wave going on at the same time where companies are farming out their MIS departments into outsourcing firms. So instead of volunteering to continue to play the game where I could be waiting for retrenchment, like the Squid Game, I decided to become a worker, right? The person in pink, right? So nobody digs my grave. Instead, I dig other people's graves, right? And so I was relatively successful for a while. What I would do is I would document the processes of an IT support team in Singapore, fly over to KL. I will train a team of engineers to take over the work in Singapore. Then the workers in Singapore will be retrenched, they will be redeployed, right? And then I will then fly over to Bangalore and I will do the same thing to the workers in Kuala Lumpur. And I did fairly well, all right, in this regard. But what happened as time goes by is that one day when I was in Bangalore and on another project, I received an email that one of my colleagues in Europe, whose contract was not renewed, he sealed himself up in his bathroom, switched on some kind of a barbecue device, and he died of carbon monoxide poisoning. So in essence, losing his job caused a European colleague to commit suicide, right? And so, when that happened, I was quite distraught. I wasn't really able to do my work for the next few days. And I realized that there is really something wrong in this industry, right? And you find that a lot of these things that have gone wrong in the past is happening again today, right? In the past, it was the engineers of my generation. Now you're seeing computer scientists of my generation slowly getting displaced by AI, right? So at that point of time, I wanted to find a cure, right? The poison of outsourcing is destroying jobs, it's destroying livelihoods. But what can we do to try to solve that problem? I thought the answer lied in financial security. So I began to study finance very aggressively in my evenings, right? Instead of like the MCSE, the Cisco certifications, I really went full throttle on the CFA Institute, right? And after I self-studied, I realized that a lot of these financial models don't really work for me because it's not easy to apply consistently to calculate the valuation of a company, right? Until I read this paper that changed my life, right? This paper is entitled Surprise, Higher Dividends Equals to Higher Earnings Growth, right? And it says here that the historical evidence strongly suggests that expected future earnings growth is the fastest when current payout ratios are high and slowest when these payout ratios are low, all right? What does the paper actually mean? It means that companies that generously gave a dividend to a shareholder, they don't hold on to a lot of cash, so they cannot engage in empire building, right? Managers cannot sit down, take the money, use it to decorate their offices with Renaissance artwork. They can't install golden taps in their toilets, right? So over time, these companies are run in a very common sense, very down-to-earth manner. They grow faster than companies that retain their earnings, right? Which goes against some of the fundamental principles of finance that I learned in school. And with this idea, I decided that, maybe it's time for me to start putting money where my mouth is. So I started liquidating the unit trust that I have. And I started buying companies like, 20 years ago, there were companies like Singapore Press Holdings. They don't exist anymore in the stock market. And so a company like SPH in the past, it cost $4 to buy. And what it does is that it pays a 6% dividend every year. So every Christmas, 4 days before Christmas, which is my birthday, I will receive $150 from SPH. And then I realized that, this is a life-changing moment, right? Because in the past, my mom had to look for insurance premiums to pay an insurance company. But now, if I put my money in a dividend stock, I'm able to receive payments, right? And what a life-changing moment that was for me. And that was how I actually discovered a new way to live, right? So you can imagine our lives like this, all right? I'm just drawing a graph here, okay? And our expenses is this horizontal line that I have, right? It was about $1,000 when I was a bachelor, okay? And I have a investment income every year based on the tiny portfolio, maybe 1 or 2 stocks, but it's very small. But if I buy more and more stocks over time, if I have 20 to 25 stocks that paid a steady dividend every year, eventually, right, I would be able to get a certain amount of investment income that could exceed this baseline, right? And it's that point of time, we call this the crossover point. And beyond the crossover point is a ridiculous amount of freedom because you don't need your salary anymore, right? You can continue to work, right? You can quit your job and look for a different job, reinvent yourself. But basically, you are the captain of your ship. You are the master of your own fate, right? And I was able to get there at the age of 32, right? Yeah, but subsequently, I did something that is a little bit unusual because we didn't have the FIRE movement at that time. So my aim was actually to take my entire income and continue to farm it into the stock market until my net worth hit 1 million, then I can call myself a millionaire. So that was what I wanted to do at that time, right? And when it comes to your summer, a lot of you are listening to me because the work is not as engaging as before. Workplaces have become actually quite toxic. And there are people in China who are resisting the 996 kind of work culture, and they are lying flat, right? They call this the Tangping kind of movement. And we have the Great Resignation in the US some time ago during the Biden administration during the pandemic. And India calls it a time pass movement, right? So one key question that people want to ask in summer is, is that all that is in life? Can I do something more relaxed instead of just slaving for someone else, right? Work is getting very, very cutthroat, very, very difficult, right, in Singapore. And at the same time, in your summer, the financial institutions want to have control over your investment strategy. All right. They have trained a very motivated pool of supporters. They make commission from sales. They're constantly calling you to meet you at McDonald's. Okay. And then they're trying to sell you an ILP, right? I'm sure a lot of fresh graduates, whether they're poly graduates or university graduates, you experience this at the beginning of your summer, right? And if you are too agreeable, right? If you're financially ignorant, right, then what would happen is that you'll be sold these products that can sap your returns for up to 2 to 3% every year, right? And it can affect your ability to generate wealth over your long term if you refuse to educate yourself. Right. And what's the worst thing that can happen? One of the worst things that can happen to you can be found in the case of IPP Financial Advisors Private Limited and Saimi bin Jumat. This is a 2020 case that was resolved by the Singapore Court of Appeal. Right? The story is very interesting. A professional horse jockey bought insurance from Prudential, and due to industry turnover, had his account taken over by an advisory group under IPPFA. So basically, this person didn't choose IPPFA. This person had a different insurance agent. There was industry turnover, and so this person came under this Vineyard Group, all right, this Vineyard Group under IPPFA, and the group's managing partner convinced him to invest in Forex, even promised a capital guaranteed return of 40% after a year, right? Now, this jockey believed that IPPFA approved of the Forex investment, and it was found that actually the managing partner was an investor in that Forex company itself, right? But what resulted was $700,000 was invested into the scheme. And obviously the scheme was unable to pay the investor, right? It couldn't pay. So there was a lawsuit because the investment money was lost, right? So my question for you guys is this, right? Given the facts of this case, did you think the horse jockey won the case? Right? Yeah, and here's the interesting answer. The horse jockey lost, right? Because the case commenced too late. It was time barred. So folks who invest in investment schemes need to know that legal liability accrues the moment a payment is late, right? And investors have a 6-year timeline to pursue justice in court. Otherwise, it is a time bar, right? And this case is now being taught to all paralegals in Temasek Polytechnic. All right. Yeah, so what an interesting case, right? I could use the case to teach my students in law, and I can also teach the people who come for my previews, right? This is one of the worst things that can happen if you don't educate yourself and there is turnover in the industry, right? And of course, in summer, there is skills depreciation. The half-life of your knowledge is getting shorter and shorter. Your mortgages continue to take 25 years to pay. You don't have a lot of time to earn your keep in the modern economy, right? AI is making everybody obsolete at a much quicker pace, right? And in summer, you earn the most money at this period of time. You're at the peak of your energy. But if you spend too much time indulging in your lives, you will pay the price later on. So what's the myth in summer? The myth is that retirement is impossible unless you listen to an advisor, right? Unless you listen to an advisor. Okay, and before I begin, I need to explain to you what retirement is. All right, so I'm going to spend the next few slides trying to explain to you what are the key assumptions when it comes to early retirement? All right. The first assumption is you will need $500,000 to retire. Right? How do I derive the number? In 2021, a single person at the age of 55 would need $1,768 a month in order to lead a dignified existence, right? And this is based on the study from the Lee Kuan Yew School of Public Policy, right? It's a little bit dated. I'm waiting for the new results for 2025, right? Then I can update the numbers. But using these numbers then, we multiply by 12, and then we divide it by this thing called a safe rate of withdrawal, or 0.044%. What is this safe rate of withdrawal? Right, the safe rate of withdrawal basically means that if you have $1 million in the stock market, you can spend 40,000 every year, and you won't run out of money for the next 35 to 40 years. Enough for a credible retirement plan. So the finance industry has fixated on this 4% as some kind of a solution to retirement planning. Okay? So if you crunch the numbers, you will end up with a number like 530,400. Okay, so you need $500,000 to retire, right? If you're not feeling particularly secure, then maybe you bump the number up to about 600,000. All right. Okay, and that's what you need. The second assumption is we only have 10 years to be able to do this retirement planning, right? If you are someone who has completed national service, you've completed a 4-year degree, your first paycheck will be at the age of 25. Then when you start work, you are looking at maybe trying out different companies. You're not settled down yet. You might switch vocations through some kind of a master's degree, right? For engineers, a lot of engineers study an MBA, right? By the time you settle down and you start making money for real, you'll be 30 years old. Then, for the rest of your life, right, you'll be peaceful until your 40s, where you will start maybe getting retrenched, having difficulties looking for a job. And what the government will do is that they will make you sign up for some professional conversion plan, right? But the lesson of it all is that at the age of 40, your life is, you're going to see a lot of turmoil, a lot of chaos, right? Because you're trying to maybe reinvent yourself as a healthcare worker, right? For my generation, a lot of engineers my age, right? I've known at least one who's driving a cab today, right? In spite of getting a local degree 20 over years ago. So if you arrange everything in a timeline, you find that you have 10 years of uninterrupted work, right? Beyond that, anything goes. So the second assumption is that you have 10 years to actually prepare for the $500,000. The third assumption is that for most people, you can save $2,000 a month, right? I use the median income numbers that are a little bit dated, but if you adjust by inflation and then you deduct from CPF, $2,000 a month is about half of your take-home pay. And you can muster enough willpower to save that amount of money if you're aggressively planning for early retirement. So these are the three assumptions that I have. All right. Now, with these three assumptions, we can then go on and we want to look at what insurance agents can find for you and what retail bankers can get for you. All right. So we're going to go through this one by one. All right. Let's look at the insurance products. Okay. And let's look at an endowment plan that gives an interest rate of 3%. All right. So how long will it take to reach $500,000 if you can save $2,000 a month using an endowment plan that gives 3% every year? And we use a compound interest calculator to help us do that. All right, we key in the annual amount, right? And for the number of years, for the interest rate, we put it in, right? And then we increment the number of years that we need, right? To save the amount of money, right? Until we can get the future value above $500,000. All right, so we keep increasing this amount until we get $500,000. So this is what we do, right? And you find that it will take 17 years for you to get out of the rat race. 17 takes far too long, given that most of us, as I've explained earlier on in our timeline, the best case scenario is to do this within a decade, right? Okay, so what happens if we were to use a short-term endowment? All right, it's actually 3% yield, 17 years, right? Then the person selling you this insurance product or investment product will attempt to sell you a long-term endowment. And the long-term endowment, they can promise up to 4.25% yield, right? And if you key in 4.25% and go through the compound interest calculator, you get out of the rat race within 15 years. Slightly better, but not good enough. And finally, a lot of these insurance agents are now plugging these investment-linked policies, and they're trying to push for a 5% yield. Okay, and this 5% yield is a very generous kind of assumption, because when you buy an ILP, you have to feed an insurance program. There are administration fees, there are early surrender fees. Put all of them together, even if you have a unit trust that gives a 9% return every year on average, after deducting 4% as the cost of maintaining the ILP, you only have 5% left, right? So if you key in 5%, you're able to get out of the rat race within 14 years, right? So none of these insurance products sold by the markets will allow you to meet this very aggressive early retirement goal, right? Yeah, but so what about banking products, right? Relationship managers love selling unit trust to you. And what I've done is that I've taken the unit trust, I've given a generous assumption of 10%, right? 10% returns, but you have to deduct all your fees, your rep fees, all your strange commissions. And I've deducted 3.5% from it, and you get a return of 6.5%. And with that, you can only reach your goal within 13 years, right? So basically, Singaporeans pay more than their foreign counterparts when they're buying unit trusts, largely because of this thing known as a trailer fee. And this trailer fee is then kicked back to the bank for the distribution fee. Okay, and this is discussed in the Business Times in an article, Why Singapore Retail Funds Costs Remain Stubbornly High, right? So what am I trying to say, right? Is that if you surrender your financial destiny to someone else, especially a sales professional, you're going to fail in your mission to retire on time, right? Because of this problem known as a conflict of interest. They want to earn money from you, they want to retire early, but you want to save the money and you want to retire early. So who wins, right? Who wins? Somebody, there has to be some kind of a compromise, right? And generally, the person who wins is the person who has more information than the other person. There's information asymmetry, right? Yeah, so I think that's the fundamental problem of buying these products from sales professional, right? So how do we actually retire early, right? You have to take the law into your own hands. You have to do a little bit of DIY, right? And how do you do this, right? And of course, for the examples that I'll be sharing with you later, I mainly focus on Singapore stocks. So why Singapore stocks, right? When the Fed began to cut interest rates last year, it began to favor dividends investing in the local stock market, right? Singapore stocks, there are no capital gains or dividends taxes for local investors. There are also no problems with estate planning if anything happens to you. The stocks that you have will be transferred to your children without any estate taxes, right? Singapore is a value-driven high dividend market. So if prices were to go down, it actually becomes easier for you to buy dividend stocks. So this is a very forgiving market, right? And most importantly, the STI is now around 4,000 points right now. It is considered a safe haven currency. Fund managers are liquidating their stocks in the US. They are moving their funds to the rest of the world, right? And Singapore gets a decent share of it because our currency is strong and we are strengthening very rapidly against the US dollar, right? So that's why Singapore stocks, okay? Now, Singapore stocks are still considered rather cheap. In April, the price earnings ratio is about 11.89. So the long-term return for the Singapore markets continue to be attractive because you have to invert the 11.89 to get about 8.4%. So if you consider a 3% inflation, right, the long-term returns estimate remain 9 to 12%. Okay, moving into the future. If you do a similar calculation on the US, right, you're looking at a P ratio of about 23.8 in April. So the long-term returns for the US doesn't look good. Okay, so the US markets is driven by narratives around AI and technology. It can be volatile if the stories don't gel with reality, right? And everybody is experiencing this right now because there is a meltdown, right? The Trump tariffs meltdown is happening at the moment. Okay. All right, so let's talk about rookie strategy involving the STI ETF, the Straits Times Index Exchange Traded Fund. All right, so this is one counter that when you buy it, you can own all the major Temasek companies, right? You have 3 banks, DBS, OCBC, UOB. You've got, I think, 8 real estate investment trusts that you can buy, and you've got stocks like SGX, Venture, ST Engineering, and Singtel, right? So these are blue chip companies. You buy one index, you get all of them at the same time, right? And what happens if you've done this for the past 16 years or so, right? The annualized performance is about 6.2%. It takes about 14 years to reach $500,000. Not too good, not too bad, but not good enough, right? The risk is, I would say, moderate, right? Standard deviation of 18% is about the same as many other markets. Okay, so it's not very controversial. The returns have only started being very good recently this year. Okay, so this is what happens if you buy the STI for the past 16 years or so. Now let's see what happens if you understand the weakness of the STI ETF. As it turns out, the ETF is a capitalization weighted index. What does it mean? It means that when you buy the ETF, more than half of your funds will be locked into our banks, DBS, OCBC, and UOB, right? The bigger the stock, the larger the allocation. So if banks do badly when interest rates begin to drop, the STI is likely to underperform, right? So how do you solve this problem, right? One solution is to buy each of the STI counters in equal weights. You have $300,000. You go to the Business Times, you get a table of the STI stocks, and then what you do is you put $10,000 into each stock, right, in equal value, and instead of buying the ETF. And if you're able to do this, what happens to your returns? It improves. From 6.2%, it improves to 9.11%. The risk does go up. You notice the standard deviation does go up by quite a bit. But at 9%, it takes only 12 years for you to reach your retirement target, right? And of course, you will say, Chris, I don't intend to buy 30 counters. I don't need to buy all of them. I just need to cherry pick the ones that I think would do slightly better, right? And this is what we mean by factor selection. Factor selection can improve the risk and return characteristics of your investing. So instead of buying 30 counters, can we shortlist 15 with a superior trait, a superior factor, such as higher dividend yield or lower price to earnings ratio or lower price to book ratio, right? In this example, what we will do is that we will turn to the Straits Times and we will look for the dividend yield column that I've highlighted in red. I will look for 15 stocks that give the highest dividends. I mark them down, 15 of them. I buy them, okay? And then the following year, I look at the Straits Times again. I mark 15 of the stocks that gave the higher dividends and I rebalance. I sell the stocks and then I buy the stocks in a new list. I do this every year, right? For the past 16 years, what would happen to my returns, right? It would improve. From 9%, it will improve to about 10%, and the volatility is more or less the same. So we're getting higher returns at a lower risk when we decide to pick and shortlist 15 of the highest dividend stocks on the list, right? So our retirement plan has improved further to 11 years. It takes 11 years for us to reach that mark? Well, not exactly at 10 years yet, but 11 is not too bad, right? And now you would have guessed, right? If you can pick using one criteria, why don't we use computer software to apply multiple criteria to choose a stock, right? And so in my program, I do teach the computer software on how to do this. We can do a little bit of stock screening, okay? And if you shortlist 15 stocks with the highest dividends, followed by 7 with the lowest volatility, what would happen is that for the past 20 years, your returns will go up to 11.13%, right? 11.13% at the same risk, right? What will happen is that the number of years you need to reach that retirement is now just 10.7 years, right? Which is as good as it gets, right? When you shortlist 7 stocks, it is not that easy to come up with a more advanced strategy to come up with better returns. You run the risk of this problem of data mining, right? Which is a problem in data science, okay? And so how do we actually get within 10 years? And that is therefore a question of how much risk that you can take. Brokers, when they look at the kind of portfolio that you have, they will find that whoever employs this strategy of high dividends and low volatility, they will pick stocks that are very, very conservative, such as the stocks that I've listed here on this slide, right? You've got Keppel DC REIT, Mapletree Industrial Trust and Venture, right? So these counters, right? And what the broker will allow you to do is that they will let you use these stocks as a collateral to borrow money to buy even more stocks. So for every dollar that we have, we can, through the help of a margin account, leverage by 2. In other words, for every $1 I have, I can borrow another dollar. And our return would then jump from about 10.2% to 17.26% at a borrowing cost of 5%, right? Yeah. And if you have a leverage account, you can then increase your returns proportionately to about 7.3%. And this will allow you to reach your early retirement target by 9 years. Okay? But there is a problem, and the problem is the volatility of your portfolio. You look at the volatility of a portfolio, it has almost doubled from 24 to about 48. That puts your portfolio at a very dangerous state. So using a margin account is not a game that everybody can stomach, right? And you will need some additional training to be able to tune your portfolio to reduce the volatility to a certain number that you can handle, right? And so that is the lesson for summer. Now, return is possible, but you need to level up your investment knowledge, right? We started with an ETF at about 6.2%. And then when we equal weight the components, we increase the returns to 9.1% because we understand the structural weaknesses. Then we started to cherry pick the stocks that gave a high dividend. So we got 10.9% here, right? And then if it works with high dividends, we can then subset by looking stocks with a high dividend and a low volatility to increase the returns further, 11.2, right? And then given that our portfolio has become very conservative, very stable, very safe, right? We borrow money from the broker and we double the size of our portfolio. We pay the broker their margin fee, right? And we're able to increase our returns to 17.3. But that's only if your risk appetite is able to stomach a leverage account, right? This is not a lesson to encourage the use of leverage in an investment portfolio, but this is something which I hope that many of you will be convinced about, that it is possible to level up your investment knowledge to get a certain return that you want based on your personal risk appetite. You need to go through a journey of self-discovery in order to do this. And the lesson in summer is about how you can apply knowledge to gain an edge in the financial markets, right? And that is the end of our summer discussion. Our next season, is about the season of autumn. And this is where your life begins to slow down. Your happiness reaches an all-time low. And this is when the midlife crisis begins to affect a lot of people listening to me today. And the majority, I think maybe a slightly smaller minority will be going through autumn in your life right now. And so for me, my autumn started in a very bad way. I started to make some career mistakes in my life. When my daughter was born, I wanted to move from the private sector to the public sector to get more job stability, as well as get more work-life balance. And how wrong was I to do that? I ended up in an environment where it was very, very toxic and highly elitist. I remember getting into an argument with a senior director over a programming language called Ruby on Rails. And I was explaining to him that you could actually build a website with a functioning database, business logic, as well as a front end with one line of code, one prompt command, right? And he didn't believe me. He said, if it is so great, why is this not being adopted all over the world? And so we went back and forth. We had a debate. And I was clearly winning because I can code, right? Yeah, unlike these old dinosaurs, I can code. And I recently came out from a coding boot camp. And we fought until he realized he was losing. So he got his favorite scholar. He called the scholar in, a young man who has just graduated from an Ivy League university, a data scientist. And he said, who's right, Chris or me, right? Which is very petty for a senior director to do that to a mid-career grunt, right? The scholar took a look at my presentation, and then he turned to the director and he said, with all due respect, Chris is right, because I can also code in the programming language. And whatever Chris is saying is conventional, and people are doing it in the States right now, right? You would expect the senior director to pick a fight with the scholar next, but no, because the scholar is this blue-eyed boy, the senior director actually let me win the argument and proceed to do whatever I wanted to do. But I was so angry after the exchange. 14 years of working experience didn't count for squat compared to the words of a scholar. So I had my first run-in with the scholar-farmer culture in a statutory board. And I decided that I really needed to get out from the organization. It took me 3 months to get into serious trouble. This time round, a lady supervisor called me into a glass panel and started shouting at me at the top of her voice like an insane mad woman, right? Everybody in the office could hear her screaming at me. And it took me a while to calm her down to find out what was wrong. And this time, she accused me of acting too quickly and decisively for the customer. Right? Yeah, which is a ridiculous accusation. So I told her which paperwork I missed out on. Instead of helping me find the paperwork that was missing, she started shouting at me even louder, as if the problem can be solved by just shouting at an employee, right? And it was then that was the straw that broke the camel's back, right? The toxic culture, the elitism, and now the sheer amount of disrespect. I just told my boss flat in the face, I said, you can't help me solve that problem, right? Fuck you, I resign, right? And that was then, right, when I decided to fire my boss. Okay, all right, let me explain to you what is the maths behind this, all right? So I have a family by then, I have a daughter. And the truth is that companies realize that if you're a family man with a kid, they think that you need the job. And so they would happily abuse you, right? Thinking that you wouldn't leave. But this is my family expenses, all right? And my passive income is here. And this is actually my take-home pay. And my passive income is somewhere here, right? So I'm earning more money than my take-home pay for the statutory board. If I leave, I still have enough dividends to support my family. I can find something else to do in my life, but the important point is that I'm not someone that can be abused in the office. I can fight back, right? Yeah, so at the age of 39, I found myself without a job after I resigned. And that was about 12 years ago, 13 years ago by now. And having the rest of my life ahead of me, I decided to do something that no IT professional would do, right? I left the rat race. I went back to SMU and I studied for a Juris Doctor program. So it was a law degree. I spent 3 years studying law with people half my age. I was admitted to the bar 7 years ago, right? And why am I talking to you, right? Running an investment course. The thing is that the reality of adults when we go through retraining, when we try to reinvent ourselves, this is before the age of skills future. A lot of people do not succeed in reinventing themselves. I was 45 years old when I got out from law school. I became a lawyer, but I really wanted to do corporate law. I wanted to do M&A, and I want to advise businesses. And I took the modules based on that. Unfortunately, the work that's available for the law firms that wanted me are the family law kind of operations, as well as the criminal law work, which I didn't really enjoy because I didn't like the emotional burden of bringing family law cases back home every day, right? Yeah. So when Dr. Well offered me the opportunity to show people how I did my finances to go through all this, I jumped at the opportunity to create a new product in the markets, right? That was 6 years ago. And I've run 38 batches of students, graduated about 700 students since, right? And this program that I'm presenting to you this evening has generated more than $1 million of revenue, all right? So it's not, it's basically I'm the only person teaching it, all right? Okay, so I obviously approached law school a little bit differently from my peers, right? They were reading their cases. I was stuck in a room full of Bloomberg terminals where I could like backtest all these investment strategies to figure out what worked and what didn't work for me, right? And at the same time, I was able to leverage on my account to actually make my life more tolerable during that period of time because I've just lost uh, my earned income. And I have a very tiny window left for me to spend my personal funds because I had to pay for my family. My wife didn't work, so I had to support my family. I had to pay for my school fees, and I had a condo. I had an executive condo coming up, right? So I had a lot of burdens, like every other 40-year-old Singaporean, right? So by leveraging my strategy, a very conservative local strategy, I was able to generate enough dividends to not just pay for all my expenses, but to be able to reinvest in such a way that I'm able to graduate from law school with a higher net worth than on the day I entered law school. That gave me a lot of flexibility to say no to the job assignments that I didn't like. Right. And so that is the essence of actually how well you can sleep at night with your investment portfolio. For most people that want to upgrade themselves by studying for an MBA at INSEAD, for example, you need a sizable amount of savings, but you do draw down and you end up having a lower net worth when you graduate, right? But when I graduated with my third degree, my net worth was actually higher. So the lesson for you guys in autumn is that the cost of living is continuing to go up in 2025, right? GST is 9%. There are two hot wars in Gaza and the Ukraine. Now, I have noted that the latest the inflation numbers are actually quite good, but do take note that our Nanyang coffee prices, it's already above $2 at most outlets, right? So we have a cost of living crisis, right? And the government has taken note of that. And that's why in the middle of the month, you'll be getting some CDC vouchers. Okay. Now, retrenchments are actually very bad this time. The tech retrenchments are back in full force. They might be related to productivity gains arising from AI adoption. And I think Microsoft is going to release 9,000 workers. I think this is the third time that they are releasing people. And Microsoft is a profitable company, right? So imagine that a lot of these IT firms are trying to get rid of their personnel right now. Okay. There's also ageism and jobs discrimination in government data. you find that for every additional year that you work, right, you should be worth 5% more. And somewhere at the age of 45, just mysteriously flatlines, all right? Mysteriously goes flat. And this is what I suspect is how you can visualize the amount of jobs discrimination that occurs in Singapore society, all right? We're also part of this sandwich class. We have to support our parents and our children in autumn. So it's a very conflicted kind of time to work, to be facing retrenchment, and then having aged parents that are sick, okay? And you have to support your children that might need tuition to survive in the education system, right? So a lot of Singaporeans are very unhappy. They are a little bit depressed. Okay, and so the bottom line for autumn is that you're no longer at your earning peak, right? And you're also facing retrenchment in the workplace. Okay. And investing requires a large amount of capital, right? That's the autumn myth that I want to deal with you guys today. Now, earlier on, I said that you need about $500,000 in order to have a retirement. But if you fixate on that number is very large, you will not be able to embark on a process of self-improvement if you suddenly want to make $500,000 appear out of thin air. But I think that there is a better way for you to get dividends to work for you, and this is to aim small, right? Try to get a passive income of $100 a month. And how do you do this? How do you get $100 worth of dividends on average every month, or $300 every quarter? Now, suppose you find a blue chip strategy that gives 5% dividend yields, right? How much do you need to get $100 a month? It's simply 100 multiplied by 12 divided by 5%, right? And that's $24,000, okay? And you can get this by saving $2,000 every month for 1 calendar year, and you should be able to get this $100 a month, right? Now, some of you might have this question. So how do I even get the 5% in the first place? Well, the fact of the matter is within the Straits Times Index, if you look solely at the banks and the real estate investment trust, there are plenty of these instruments that give you 5% that I show here, right? And I generated this using some of the computer programs that I'm able to write, okay? Okay, and this is during this current era with the Trump tariffs, all right? The numbers can in fact be significantly higher than 5%. You can get 6% or even 7% in some cases, okay? Now, you set aside your salary every month or every quarter if necessary, okay? But if you aim for something like 100 shares of DBS, that's very hard because it's about $4,600 today, right? But there are good dividend stocks like Netlink Trust that can be as cheap for about $90 for 100 shares, all right? So accumulate very slowly, very steadily to get that $24,000 that will eventually give you that $100 every month, okay? In essence, once your journey is complete, you will have a golden goose that lays $100 of passive income using $24,000, right? So you have a golden goose, right, that you buy by saving $2,000 every month for a year, and then it lays a golden egg worth $100 passive income every month. And what it does is that it gives you an additional $100 into your salary. So your earned income plus $100 can then be put together to get more golden goose, right? The best way you can leverage on this $100 every month is obviously you can reward yourself by buying a meal every now and then. But the best thing to do is to actually use it to buy a flock of geese, right? And that's how you can use the number of geese that you have, right? You steadily buy more golden goose until you're able to reach your escape velocity in your workplace, right? This is how compound interest can work for you. So the tip in autumn is get your first golden goose. Don't think so much about $500,000, complicated ways of making sure your early retirement goals are met, right? Everything starts with your first golden goose, $100 of passive income with $2,000 saved every month. Autumn is about taking stock and developing resilience in your life. All right, so with that, we're down 3 seasons and we're moving to our final one, which is the season of winter. Winter begins when you receive your CPF life payout, right? This is where you begin to enjoy the fruits of your labor and your happiness goes up again. I have my usual round of travel with my family, but I think more importantly, I prefer to focus on simple living and what financial independence can do for you. Uh, this is what I think financial independence is all about. Getting a kaya toast, butter coffee in the middle of a weekday afternoon with nobody controlling your time, right? So I think that's what financial independence can really bring out for me. When I traded my corporate life away, the question that I can afford to ask myself is, right, if I have nothing to do, if I trade off 1 hour of work with 1 hour of leisure, what happens, right? If you currently have a job and you want to reduce your working hour by 1 hour, right? That's impossible. No business leader or boss will allow you to do that, right? So you have to work your full amount of hours, or you can resign and work 0 hours, right? A person who's financially dependent begins with 0 hours, and I can steadily increase the amount of work I do, either as an investment trainer or a polytechnic lecturer. I can do that to increase my life satisfaction. So if I were to increase an hour of work, I earn the pay. Would I be able to get more life satisfaction as a result of that? Right? So that's a question that I should be asking yourself, right? Of course, your expenses will also drop during winter. Your overall expenses will drop by about 30% from age 55 to 65. You'll be spending more money on home cooking, furnishing, and amount that you pay for healthcare and all that would begin to go up. All right. We also age in bursts. When you hit the age of 44, there's a large drop in your metabolic rate, so you find it harder to go to sleep after a cup of coffee, right? But the next phase where you will age a lot is at the age of 60, right? And that's still 5 years away from your CPF life payouts, all right? So retirement planning is critical before you meet these timelines. We also have longevity risk. Singaporeans are one of the longest life expectancies in the world, living up to about 85 years. You're healthy up to just 72 years, right? Your health span is shorter than your lifespan. So if you live too long, you will suffer for about 12 to 13 years of your life, and living too long becomes a possibility. So you need to manage your longevity risk, right? And if you're a good soldier, you have the full retirement sum of $200,000 in your CPF special account, right? If you're 65 years old today, you would be able to receive $1,150, right? Every month, right? But according to the Lee Kuan Yew paper, you need $1,421 a month to have a basic standard of living, right? What does it mean? It means that there is a shortfall, right? After adjusting for inflation, you still need about 4 or 5 golden goose, or you rent out a room in your HDB flat, right? In order to be able to have enough cash to endure your years as an elderly, right? We have a problem in Singapore where everybody's wealthy, but you're asset rich, right? But you're not cash rich, right? In order to be cash rich, you have to put your money in an annuity plan like CPF Life, and maybe you can get a monthly income. But unless you learn how to deal and manipulate dividend stocks, right, you're not able to get passive income in a very consistent manner. So the solution of retirement inadequacy is to combine at least 4 golden goose with your CPF Life. What happens at the stage of winter depends on how well you deal with your previous stages of your life, right? I mean, you reap what you sow in winter. And the myth in winter is that market crashes can destroy your life. Okay, let's talk a little bit about the Great Recession of 2009. I think it is probably the worst recession in memory for the people of my generation. At the time, I was working in a commodities exchange, and I farmed my entire salary into the markets, only to watch my net worth shrink even lower. I was joking my friends that I've lost an entire BMW to the stock market in those years, right? And I was the butt of all jokes because my colleagues, they are not invested in the markets, right? It's very funny. The people who work in a stock exchange, they don't like to invest their money in the exchanges, right? But I knew something that these people don't. And the thing I knew is that if you were to look at all the market crashes throughout the history of Singapore, the longest crash we ever had was in 1996 to 1998, known as the Asian currency crisis. Okay. And this lasted 706 days from the top to the bottom. So when the market begins to bottom out, right, I will record the ending of the crash. Okay. So if you know that you are in the middle of a recession or crash, the dumbest thing to do is to liquidate all your stocks and run away. What you need to do is that you need to stay invested, you need to have a job, you need to continue to farm your money into the stock market until the market finally recovers. And that's what I did when the global housing bubble exploded, right? Okay. And yeah, and that's exactly what happened. When the markets began to recover, right? My friends are shocked. I'm the only person that's recovered in the markets. And I told them that, the BMW that I've lost has come back as a Maserati. And that's how I made my first million, right? Market crashes are your ally in wealth building. On December 2008, if you look at the kind of yields that our real estate investment trusts were giving, right? We have things like Suntec giving 16%, Mapletree at 16%, this is Ames REIT, 36%, right? So they're all fantastic investments, and buying at that moment of time could turn you into a millionaire. Right? So I think right now there is some concern about the Trump tariffs. Okay. The current high rates generally will hurt US businesses more than the economies of other people, right? And Trump has actually backed down from a lot of his threats. Okay, he has also de-escalated from China. But based on an analysis on the edge, my belief that the 10% tariff is not avoidable, right? It is still in place today. Okay, we can try to see whether Singapore can negotiate this down to zero, but the US has a trade surplus with Singapore, so we won't be bullied so much by Trump's letters. Trump has been sending out letters to different countries right now, so causing a huge panic and a lot of unhappiness in Malaysia as well, right? So this is what I think. Okay, now your dividends are safe. They're still coming in at this point of time, right? And the lower interest rates in the future will likely benefit the REIT sector, right? Okay. And latest MAS moves to stimulate the market is something that we can look forward to. There will be tax incentives up to $5 billion to fund managers under the Equity Market Development Program that's coming up soon. And the Global Investor Program is going to support funds from family offices. So you notice that there's some changes in the rules for family offices to get more money into our local markets. So there's a lot of stimulus occurring in the markets this year. Expect more announcements before the year comes to an end, but we are already above 4,000. I think 4,001 is not too far away, right? So the tip in winter is market crashes are your allies in building great wealth. Winter is about enjoying what you have and cherishing the time that you have with your grandchildren, right? Okay, so we are done with the 4 seasons, and I've shared with you 4 seasonal truths to counter the 4 myths. Let's go through them one by one. The first is that your X factor can come from reading popular finance books like that of Robert Kiyosaki. That's not true. You need to invest the time to learn finance the hard way, right? Second, retirement is impossible unless you listen to an advisor. I've shown you how those products will not be able to allow you to retire on time. Instead, retirement is possible if you're willing to level up your investment knowledge, right? Pick up the knowledge yourself. No one cares about your money more than you. Thirdly, investment requires a large startup capital. That's not true. Focus on getting your first golden goose. It's an easy way to decide whether this method of investing works for you. And finally, market crashes can destroy your life. It's actually not true because market crashes are your ally in building great wealth, right? So what am I really driving at in this evening? I've been talking to you so much about your life in four stages, all the different problems that you have, especially from a financial point of view. But what I'm really driving at is this. The Singapore dream is dead. You think about that traditional kind of advice, right? To go to school, get good grades, study for a good professional degree to get into a profession, get a good honors classification, hold on to a steady job, work your way up, accumulate the 5 Cs along the way, and then retire at 65 after CPF Life comes online, right? The whole point about going to school is that school doesn't prepare you for the financial world, right? And even if you get good grades, it's very competitive to get into a professional program these days. You read about how insane it is. People need to audition to join a CCA group, the finance club, right? How ridiculous is that, right? Okay, then you need to get a good honors classification, okay, and then you get a steady job. There are no steady jobs in the age of AI, right? As you work your way up, you have to deal with backstabbing, abuse, toxic workplaces, just to put a little bit of money into your pocket, right? Along the way, you might let your golden handcuff on yourself by picking up on a mortgage, right? And then you accumulate your 5 Cs along the way, and then you retire at 65. And CPF Life isn't even enough. I've illustrated to you that the value of CPF Life when you hit 65 in today's dollars is about $1,150 when you have the full retirement sum, right? It is generally not enough to sustain you for a basic standard of living, right? True wealth comes from a combination of passive income, discretionary time, and freedom of choice, right? This is the new success equation. And I like to present to you this new Singapore dream, right? In this new Singapore dream, there are no 5 Cs, only 1D. What can dividends do for you, right? Can support your children's education, let them focus on the paper chase, ease minor expenses, smooth out lumpy salaries while you settle down on the corporate workforce, address sudden expenses related to children's education, parents' medical expenses, cope with retrenchment, facilitate career pivots, hedge longevity risk, pay your medical expenses, prevent yourself from becoming a burden to your children. This is the magic power of dividends, right? When your dividends show up in your bank account, if you set everything up properly in the CDP account, the money will be credited direct into your bank account on payment date. Okay? It's like opening a present, right? If you do this across multiple decades, right? My dividends for last year was $111,000. It's on average about $9,250 a month. It is based on a portfolio size of about 2.2 million. It's actually to about 2.3 million today. All right. There is approximately 5% yield. So this is a dividend-based kind of portfolio, right? If you compare against a median household income, it's about $3,500 per head. Okay. If you were to put your money into real estate, okay, the gross yield is 4.63%, but after netting off your taxes, your maintenance of your property, you're likely to get only maybe 2.5 to 3.5%. All right. So this is the power of dividends investing. All right. But you need to be able to sustain this for a very long period of time. Okay. So we come to the end of the first part of our workshop, right? Okay. We will take a 5-minute break and I will come back at about 8:50. All right, where I will conclude my presentation on what is the early retirement masterclass. All right, I'll see you in 5 minutes. Hey, it's 8:50, so let's have a very short 20-minute discussion on what is the Early Retirement Masterclass, right? So this is a 5-day course to help you in recapturing the Singapore dream, okay? Now, there are 3 objectives: to transition you into an independent and successful DIY investor with support from a community of like-minded friends. 2, to create a secondary source of income that will meet your lifestyle needs. And 3, give you the ability to use a data-driven framework to grow your portfolio in ever-changing market conditions. All right? What is the outcome that we want? A portfolio of local companies, 15 to 20 counters for diversification, contains blue chips, REITs, and business trusts. Designed to provide 5 to 6% dividend spread across the year, consistent with our view of the current market cycle and minimum monitoring. You build a portfolio of stocks once, leave it for at least a year. All right. So that's the kind of outcome that we want. Right. So some of you might want to ask yourself, right? Can I just buy one stock like DBS and then collect 5 to 6% forever? Right. And in the past, I've actually encountered investors who just buy one stock, right? And in fact, a family friend, my dad's friend, he liquidated a piece of landed property and he farmed everything to SIA, right? Earlier generations of Singaporeans really believe in SIA the same way we believe in DBS today, right? And so when SIA did very well, my dad's friend was very generous. He bought us meals. But when SIA did badly, he went into clinical depression, okay, in his 70s, much later in life, right, when SIA began to underperform. All right. Yeah. So without a certain degree of diversification, it's actually very dangerous to just hold one stock and then expect to collect 5 to 6% dividends forever, right? But let's look at what we know about bank stocks, right, to further assess the feasibility of this idea, right? I have in the past recorded our interest rate trends from 2006 to about 2020. And we find that SIBOR, which is the previous interest rate that we use for bank loans, it was falling from 2006 to 2009, and it was rising from 2015 to 2019. Okay. And if you look at the bank's performance from 2006 to 2009, when interest rates were going down, banks indeed underperformed the rest of the STI, which is very, very important, right? Interest rates are currently heading downwards. So moving forward, banks are no longer a sure bet, right? They're no longer a sure bet. They will produce decent dividends for you. They won't lose you a lot of money, but they will underperform the STI, right? So that's what's predicted from what happened the last time interest rates went down. Okay, so back to this program, right? How do we prepare our students? Okay, we have a foundational training of 4 evenings where you spend with me over Zoom and I walk you through the basics, right? And then on Saturday, we will meet up, we will do the stock screening together as a class, and we will be assigning students into various teams to look at investments, right? And they look at investments, they would be able to assess. And this is now sped up a lot, right? Because we use artificial intelligence to help us in making decisions, right? And then after that, after a discussion, you will decide whether the stock would have a role to play in the portfolio today. And if it does have a role to play in the portfolio today, you include it in the final portfolio that we will launch as a class, right? What is special in our program is that we have a fundamental backtester to figure out what works in the stock market. Like you ask yourself, what if I were to buy low price to earning stocks that have a high free cash flow, right? You're able to come up with these assumptions and backtest them to find out whether the strategy outperforms, right? So you're able to do this, right? We have a tool for that. We also have a tool to turn a class into a room full of investment analysts. I code in this framework called Python Django. I have completed a full stack engineering course. I've built this and I have managed to to move this into the cloud. So the students have a tool that would assist them in data entry, and it will consolidate all the input into a portfolio and perform some calculations on it, right? We'll be going through multiple rounds of portfolio creation that will take up about half a day, right? The result is at least two portfolios, a blue chip portfolio and a REIT portfolio, right? That would be used to generate money for us. Okay, this is how a typical snapshot of what my program does. For all the stocks that have been approved by the students, it will generate a plot, a regime plot of the portfolio values to know whether at which stage is the portfolio crashing and whether there is an upward trajectory for you to actually buy the portfolio. It will predict the future yield of the company, of the portfolio, and it has all these statistics, right, that would be automatically calculated for you. All right, so this is quite a mouthful. All right, whenever I find a new statistic that I like, I will include it in the program. Okay, right. We are the only investment course that is backed by LLM research, right? So there is a paper by Marquette University in Milwaukee on the use of tools like ChatGPT to make investment decisions that are superior to that of most other retail investors, as well as fund managers. I've taken that approach, I've adopted it to the course, right? So we are now able to build an analyst report on a company that doesn't have analysts following it, all right? So we are able to do that in this program. Okay, and every investment decision is captured and contained in a portfolio PDF, right? So this is the input for Netlink Trust, right? And this PDF contains a list of stocks that can be executed in the stock markets the following Monday. So what my program will do is that it will auto-generate a PDF. The PDF will be distributed to students of the program. So even if you don't understand the course, you didn't learn how to fish, you will still have a fish at the end of the program, and you can eat the fish. All right. Yeah. So it is highly actionable even by beginners. Okay. And as it turns out, I think a dividends portfolio works quite well with CPF Life. If you have $1 million and you have $700,000 in dividends and $30,000 in CPF Life, we're talking about $4,500 in passive income every month, of which 1,600 is fixed under CPF Life. So you have a certain amount that is guaranteed, and you have another amount that will grow with the inflation rate. All right, so they work very, very well together. Okay, the relationship continues after the course. So we have a Facebook group that every student will be in. So the alumni can assist with Q&A, and I will be constantly putting up new material into the Facebook group. The most valuable part of this is that if you sign up and you come for my course in September, we will create a PDF file that contains the stocks that is built by the students. Then in December, when the next class is being run, right, the December portfolio will be shared in this Facebook group. So we don't have a monthly membership and there's no upsell of advanced courses. All we do have is basically just every 3 months, you will receive the latest portfolio that the students have published, and then you can use that to supplement the portfolio that you already have. All right, and this is for life. All right, there is no fee because it is a Facebook group. All right, let me talk a little bit about conflict of interest. All right, the truth is that I am with you throughout the entire process of building your portfolio, because as a financially dependent person, I don't need my trainer fees. In fact, what I do is that I get my course fees and I put them into a portfolio designed as part of the class exercise. And then for this portfolio, we will track it using our tools moving forward, right? So while I don't enjoy the course fees, I do enjoy the dividends produced by the course fees over the years, all right? And I've basically graduated about close to 700 students, all right? This is called having skin in the game. If you make a good investment decision in my class, I stand to benefit. So I will always give you the best material that I have in order to aid you in your journey to becoming a good retail investor. There is some cost prerequisites to get things to work. You will need generally a capital of at least $10,000 to benefit from any investment cost. This is just to make sure that you are able to make the money yourself to cover back the cost fee. All right, so you need capital to benefit from this class. You will need to, if you don't have 10,000, then at least have a job that pays 3,000 a month so they can save up money to slowly build up your portfolio, right? You need to know how to operate a laptop and a mobile phone. Some amount of digital literacy is required. So generally for the older folks, I need you to be able to understand things like, when a website sends you an email, it might go into the spam folder. You need to be competent that way. There is some mathematics, but it is lower secondary school maths. All right, so very simple mathematics to be able to understand my class. Right? So let's go through a case study now. The student on the right of the picture, her name is Donna. She's from batch 9. She made her first dividend in about 16 days, right? And she's able to get paid off by NetLink Trust within 16 days of attending the course, because on, I think, Tuesday, it goes ex-dividend. I told her to buy on Monday, so she was able to get some money. And she was in between jobs at the time. And when I met her about 2 years later, she already has at least one golden goose in the stock market that's generating money for her moving forward. All right, so it's a very, very powerful testament to what a small change can do in your life, to be able to change the money that you make, right? So the question is, what is the value of your personal freedom? If the cost brings you 20% towards your retirement target of $500,000, then you'll be $100,000 richer. And the cost will be well worth its price, even when you price it at 20% of the 100,000, right? Every single strategy will be documented and be presented to the class, right, at the end of the course, right? Secondly, the program has a bespoke way of generating portfolio statistics and goes into a level of transparency that no fund manager in the market can provide, right? Our output produces a trend, a time series of how the portfolio has performed over the past 5 years, and it contains all the various risk measurements to tell you how risky it is, what's the probability of losing money, how much money would you lose in a month if you actually lose money, right? It also contains every single investment decision being documented, right, by the students, right? To do something similar, you will need Bloomberg to generate all these figures for you, and you will easily need to pay a 5-figure sum in order to do that. When you sign up for the program, as a you a document to tell you how to get at least one trading account open so that you can buy stocks the following Monday, right? So there are some pre-readings that you can read. There is some basic information on brokerage. So we have a beginner's guide to actually assist you and handhold you before the course begins, right? So personal coaching like this can... I have a network of partners, right? Students in my program. Okay, sorry, I lost internet connection again, right? Students in my program can get an extra 3 months of subscription when they sign up for Stocks Cafe, and they also get a discount, right, when they sign up for Quants Cafe, right? So, more importantly, the software developer for these platforms are also... So this way, there is a very, very strong coupling between me and the person who developed the software. So the features of the software and all that can be refined further over time with feedback from the students, right? So this is a priceless kind of benefit that I can bring for you. And finally, the Facebook group, right? Like lifetime membership, lifetime updates, and generally speaking, no attempts to sell you an advanced course, right? There is no advanced early retirement masterclass that costs $15,000, for example, or it doesn't exist. Okay, so the course will tell you everything to build a portfolio in one sitting. All right. Our next session is on the 9th to the 12th of September, right? And for the 4 evenings from 7:30 to 11, I'll be talking about the missing pieces from our education system, how to understand the economy, how we perform our investments, right? And then we'll move on to different asset classes: blue chips, small caps, fixed income business trust, Singapore depository receipts, SDRs, and then REIT investing, leverage, and then insurance and government schemes. All right. Okay, on day 5, when we meet in person, right, there'll be a final quiz with prizes. Okay, there'll be a recap of what was taught, and then it'll be a series of labs where you do the work and we build a portfolio as a class. And then we will end with an emigration exercise where we talk a little bit about Joe arbitrage, right? You know, there's all this trend about people living in Bangkok and flying to Singapore to work, right? We do a small exercise on that, and I've been doing this for 6 years. All right. Yeah. So that exercise, students have found it very useful. So I summarize everything that you will get. And the course fee is 3,888. Dr. Elf staff is putting up a link, and if you demonstrate your interest, you can get a promotional price of $2,568. Right? So you can imagine, right, if you have $100,000 invested in this portfolio, the dividends alone would be more than $5,000, right? And we're not even talking about capital gains, all right? So it's fairly easy if you have $100,000 to break even for the value of this course, right? If you come for the first day, you're dissatisfied, you want your money back, don't come for the second day, and Dr. Wealth will give you your money back, all right? So this will reduce the risk of attending a course where you don't understand the material at all right? So this can mitigate that risk, make it easier for you to sign up for my program. If you commit for the next 72 hours, within the next 72 hours, we have a special package sweetener for you. You will receive PDFs of all the books that I've written so far. There is a set of beginner readings, right? And there are 2 bonus lectures that you can attend online, all right? So if you act now within the next 72 hours, you get this material for free, all right? 9 to the 13th of September, okay? The cost is $2,568. This is the full information on the program, okay? All right, so now let's move on to the Q&A. I noticed some questions popping up already. I will do my best to answer all of them as much as possible. And I will try my best. All right, okay. Okay. This is a very strange question from Zikai. How about income plan that can pay income until age 120? If you die, you get back 101 on your capital. But you can choose to nominate your kid as a beneficiary instead so they can get the income until my age is 120. Zikai, what you're referring to looks suspiciously like an annuity plan. Okay, and this annuity plan has to compete against the CPF Life program that many of us are getting into. All right. I think what is missing is you don't have any information on how much this annuity pays, but I can tell you that it will be very difficult for this annuity to give a decent rate of payment on a monthly basis, right? Yeah, and I still believe that banks and real estate investment trusts, because they can yield up to 7%, you're likely to be able to get a higher payout. But more importantly, you cannot compare an investment with an annuity, because when you commit your money to an annuity, you cannot get the money back, right? It will pay you every month, but you cannot liquidate it, right? But if you have a REIT and you have banks, right, you can sell it anytime there's an emergency. And when you die, you can actually pass your banks and your REITs on to the beneficiaries of your will. All right. So yeah. So I think what you're talking about is an annuity, right? And it's not an apples to apples comparison if you compare it to a dividend portfolio, but your annuity, you can compare that against CPF Life. All right. So that is my answer to you. I hope it answers your question. Kelly Ko, what about folks who are nearing 40 with shorter runway to get into dividends investing, but yet they've yet started to plan for retirement? So if you have a shorter runway, right, you might have a higher amount of capital, because if you're in your 40s, you won't have zero amount in your net worth, right? You might have some amount of money in your bank account, right? Then an investment course is very useful because you can then learn how to get a rate of return with the money that you already have, okay? And if your runway is a little bit short, it's fine. You just save more than $2,000 every month. and you try to build up your dividend portfolio so that you can survive maybe the next retrenchment period, right? So yeah, I think it's fine. I think there are students in their 30s, 40s, 50s, 60s, and even 70s who have graduated from my class. All right. So I think it's okay. It's never too late to pick up some investment knowledge. What are your thoughts about CPF and SRS to invest? Um, yes, you should. My course actually has one segment on CPF and SRS that would describe how you can actually deploy your funds into dividend counters using your CPF and SRS monies, right? Yeah, I definitely encourage it. In fact, it is a life skill, right? You should be able to do that, right? Okay. Zoe Link, if you want some information on the slides, maybe you speak to Dr. Elf staff to make the arrangement for you. All right. Yeah. So, okay. Let's see. Next question. Uh, Sylvester To wants to know strategy two. That means taking your money, dividing it into 30 parts, and then putting one part into every single STI stock. All right. So 10,000, if you have 300,000, then 10,000 to DBS, 10,000 to OCBC, all the way until 10,000 into like maybe a Yang Zixiang. All right. So that's the second strategy. You can always come for the next preview. Okay. All right. Zikai, how does margin financing work for the last few years when interest rates soar, right? Yeah, you've asked a very good question. When the margin financing was very high and in Interactive Brokers it was above 6%, I generally lowered my multiplier. In other words, I have very little margin financing during that period of time, right? 1.2, right? But now the margin financing rates have come down. It is actually very safe to go to numbers between 1.5 and 2. All right, so you got to know how to vary it, okay, based on the situation. All right, so my section on leverage will teach you how to handle a margin account. All right, okay, let's see. Tan Si-jin, question one, what is the risk of putting all your investments in SG and a small selection of stocks? Well, it is not a small selection of stocks. It is in fact a selection of 15 to 20 stocks. All right. And what is the risk? Okay, the risk is a standard deviation between 13 to 15, which means that in my program, we follow some professional standards on managing the risk. So we have a value at risk of about 8%, right? A value at risk of about 8%. That means for every 100 months that you've been invested, the worst month, the worst return you will get will be about an 8% drop. So you can lose 8% on a very bad month. All right. So that is the risk. Yeah, we really study risk to a level where we can try to quantify it so that you know and you can expect the worst when you invest in our portfolios. It's not that bad, right? It's not that bad. While the SGX is giving better returns with lower volatility, what are your thoughts on supplementing the dividends approach to other markets? All right, whatever framework I teach to my students, it can be transplanted and reapplied to the US markets, right? But what will happen is that for the US markets, you will not be investing in dividends or value, you'll be investing in growth, right? Yeah, my methodology can be used on other markets, all right? So, and in my program, we do have stocks other than Singapore. We do cover Hong Kong and we do cover Thai SDRs, right? Yeah, so Singapore depository receipts. Okay, so we do have we do cover stocks other than those in Singapore. SGX has become a fairly diverse kind of exchange. Okay, I hope that answers the question for Zijin. Okay, we are done for Q&A. I just have a few slides before I finish. All right, just let me finish up. The final question that I want to leave with you is a question of where are the customers' yokes, right? The trainer might be a multi-millionaire, but what about the students, right? You want to see some success stories for the students. All right, so I'll be sharing with you an aspirational illustration, Student M. Student M is one of the most powerful examples of what this program can bring. They are high-powered finance executives in their mid-30s. All right, the husband attended the class on December 2019. They have a strong foundation in finance. So they believe in it very, very strongly. So the husband and wife put $30,000 into every ERM portfolio built by the students from December 2019 to the present day. And the portfolio is a margin account with 2 times the leverage. They've invested through the pandemic. Crazy, right? They've invested through the pandemic. And throughout this period, their internal rate of return, when I spoke to them, was about 10 to 11%. They were getting 17% a year because they've leveraged the portfolio. In less than 2 years, they've accumulated over $1 million. Half the portfolio is owned by the couple if you net off the amounts owed to the broker, right? So imagine making $1 million, right? Imagine growing a portfolio to $1 million in size within 2 years of attending an investment course. Okay. So with that, I hope that you'll be happy to reinvent yourself this year. Give yourself a chance to pick up some skills on early retirement and let it change your destiny, right? You can look me up further on my YouTube channel, right? And I hope that you will sign up for my program, of course, and I hope to see you in class in September. All right. Have a good evening. Thank you very much.